Good morning. It's Jeffrey Christian of CPM Group. It's 11 a.m. on Tuesday, April 15th today in New York. I have a lot to cover today. I want to talk about COMX data. I'll explain that in a second. A little bit more on the state of the world. We talked about some of that last week and on an ongoing basis because it's the single most important thing for precious metals prices. Precious metals updates. A little footnote. Harvard's endowment is $53.2 billion. That's important because the Trump administration wants to extort compliance out of Harvard and is threatening to take away $2.2 billion of research money, grants, to Harvard. And Harvard has the backbone to say, no, we're not going to let you extort compliance out of us. Other universities have capitulated, as have law firms and others. But Harvard said, hey, $2.2 billion, it's a lot of money. We'd like to have it, but, we can probably scrounge around and find it in our endowment. Now, what I want to do today is talk about COMX data. And as we have evolved over the last several years, these videos, there's several reasons why we do the videos. One is to really, project CPM Group's presence on the internet and attract potential clients. We are, in fact, a commercial operation. We're capitalists, not communists. We do give away a lot of free information. We don't have marketing groups sponsoring that per se. We're not like the kinds of people who will come out and always have outrageously high data estimates, made up estimates of investment demand for silver or gold or platinum group metals. We are an independent research company. Our clients pay us to get data right. And we do this to project ourselves into the market and market ourselves. Nothing wrong with that. We also use these videos to memorialize information that CPM Group has that simply doesn't exist in the rest of the world. We benefit from the fact that we've been around. Really, our research operations started in the late 60s, early 70s. CPM Group was part of J. Aron, and we have a research department that became part of Goldman Sachs, and we spun off in 1986 because we wanted to be an independent, unbiased research consulting company. And since 1986, so 39 years, I guess it is, if I'm doing the math right, we have been an independent, unbiased, honest, accurate broker of research, information, data, and analysis. The third thing is to provide educational services. We did some work last week in a couple videos, and we got some very interesting comments. One was, what is open interest? You keep talking about it. Please explain what it exactly is. Another one was, where can you get all this data that you're showing us on COMEX gold and silver, open interest and trading volumes and deliveries and inventories? I'm going to show you that as we go through it. So this is going to be that third leg of the raison d'etre, why we do this. A little bit of educational work. Now, when somebody asks what is open interest, somebody else in their response very accurately described what open interest is. The COMEX is a futures exchange. It has futures contracts. These are paper contracts, 99+% of which are settled. They are used for financial transactions. Some people take delivery through the COMEX, but most other people do not. One of the big uses of futures exchanges have been around since about the 16th century. I believe they started in Japan and also in Europe during the age of expansion in trade between Europe and Asia. Basically, the merchants who were financing these ships were taking great exposure. They were raising money. They were putting money into renting a ship, sailing it around the world, halfway around the world, collecting stuff, buying stuff, and bringing it back and hoping the ship didn't sink one way or the other. And they had enormous risks, and they wanted to offset that risk. So they started saying to investors, hey, I'm going to put all this money into this commodities-oriented venture. Would you like a piece of the profits if we turn a profit? If you do, here's a piece of paper, like a futures contract, a contract for the future delivery of this stuff. And you don't have to take delivery. We'll sell it to people who want it, and we'll share the profits with you. And so futures exchanges started and were created by merchants because they wanted to hedge their exposure to future potential profits when that stuff came back, if it came back, and they were able to sell it. So futures exchanges started as a place where merchants could hedge. It's very important because a lot of people who don't understand it keep complaining that there are a bunch of banks and brokers and trading companies, i.e., merchants, involved in futures trading. Well, that's why the futures markets were created. Now, the merchant said, well, who's going to take the offside? If we are looking to sell portions of our profits, where are we going to find people willing to buy it? And the answer was investors. So we can hedge our exposure to our business, the risks in our business, and we can find investors who are willing to take a share of the profits. Not take delivery of the commodities that we're bringing back from Asia, take delivery of the profits. So futures markets have always been, just for the last 500 or 600 years that they existed, a paper settled transaction. Now, there were other things before that. In 1415, when Henry V decided to attack France, he raised money for his war effort, and he did so in part with gold loans. He went off to the barons and other royalty in England and said, I'm going to attack France. Think we can do this. Loan me money, loan me gold. And there were gold loans involved. So, and as we know from, I guess last Sunday was Palm Sunday, and there's a famous story in the New Testament of Jesus going to the temple and finding money changers. Yeah, those money changers were in essence doing futures transactions. They call them forward transactions, but yeah. So open interest, to get to the point, is as you sell contracts and buy contracts on the futures market, the open interest is the number of contracts outstanding in any given month. And I'll show you more details in a second about this, right? But in any given contract month, there is open interest, the number of contracts, and you only count one side of the transaction. You don't double count it by saying, oh, there are some foreign exchanges that used to double count, and then you always had to know to divide by 2 when you were adding all the numbers together. So I have a chart here on the left, which is the gold COMEX futures open interest total across all contracts. And you can see it's basically 40 to 60 million ounces of gold at any given time over the last really about 10, 15 years. Well, closer to 20 years now, about 18 years, since around 2007. Sometimes it spikes higher, it's growing sharply, right? That's the open interest across all contracts. And I'll show you a breakdown there. 99% of the contracts that are traded are in the first 3 months, specifically the nearby active, which is usually the first contract after the current month. Right now for gold, that is the June contract because April is an active contract, but it's pretty much rolled forward. So June and August gold contracts have about 99% of the open interest. There's very little. Some of it goes out 12 months, and then beyond the 12-month period, there's very little. And the prices, those futures prices, are determined by a settlement committee. If there's no trade, if there's no trading in a given contract month, a settlement committee will get together after the close and say, well, if the contract's prices in the first 3 months were X, Y, and Z, and the interest rate is A, then the futures prices would be C. is very important because people think that the futures prices somehow or other reflect what the market expects in the future. That's not true. The futures price reflects the current price and the interest rate, and sometimes a premium, especially in the over-the-counter market as opposed to the futures market, for the risk involved in holding that position over the duration of that contract. On the right side, I actually put in the trading volume to show you that too. The trading volume is a multiple of the open interest. For any given contract, there are, maybe you can see here, then a lot of it's been 400 to 600 million ounces on a monthly average. And it's spiked up to over 1 billion ounces, right? That's because those contracts trade back and forth. And that's important when you get into deliveries, because people don't realize that the deliveries also trade back and forth. I'll show you some charts in a minute, and you'll see why it is that these are in two different scales. This is some of the data that is available for you for free. People said, where do you get all this data? And what do you have to pay for it? A lot of it's free. And I'm going to spend some time now going through some of these things, but I'm putting up these links here. The first one is delayed prices. If I think a 10 or a 15-minute delay, that's free. If you want live prices, current prices, then you have to pay for them. Either pay the COMX fee, I believe it's a monthly fee, or in the case, like, for example, CPM Group, we have a brokerage house that we use for client transactions, and they provide us live prices. But you can get free delayed prices from the COMX at this first link. Then you can see separate other things that I'm going to run through for you. Gold information in general, silver information in general, gold open interest, gold deliveries, silver deliveries, inventories, and deliveries. So let me see if I can do this without being too clumsy. This is that first page I showed you. It's the COMX delayed prices. And this is the sheet right now. So you can see that 15 minutes ago, the June active gold futures contract was $30,234.90. Silver was $32.10, and platinum and palladium were both at $9.69, both up about $11 each. So there you have that. Now that's the prices, and you can see the high and the low. Gold got as high as $32.49. Almost back to its record 2 weeks ago. Earlier in the day, and silver got as high as $32.43. Now, if you go over here and you click on this and you open it in a new tab, what you get is all kinds of information. The first thing you get is an overview, so you can understand what it is that you're looking at. But I'm going to click on here, settlements, and I'm going to show you here. These are the settlement prices yesterday, the highs and the lows, and the last traded price in the official trading day yesterday afternoon, the change from the day before, the settlement price, and then the estimated volume, and the prior open interest. And this is in contracts, right? So here you can see the April contract right now. It's down to 1,194 contracts, 100-ounce contracts. That's 119,000 ounces of gold. The roll has basically gone forward. You can see May has only 523,000 ounces, but the active June contract, that's up there at 39.9 million. So that's where all of the activity is. Now, if you go down here, you can see previous days open interest, and you can see the estimated volume, and you can see there's very little volume in some of these contracts going forward. February 26th, so 10 months forward, you've got some. the next thing I want to do is show you this. You go here. I went to the search button on this page, and I have it that it pulls up automatically. I click on silver inventories, and what I get is a menu of things that are available. Now, I can click on here and get the silver stock report. Let me do that just to show you. It gets downloaded, it gets opened in Excel, and there's all of the silver inventories as of the 11th, because there's a day's lag. So this was the report that was issued yesterday. There'll be a report this afternoon. I think the reports are issued at some point in the afternoon. And you can see this was the data for yesterday. You can see each of the deposits that is a COMX registered depository within the capture area. You can see, you can see who's got a lot of silver. CNT, 35 million ounces. Brinks, 84,000 million ounces. Asahi, 85 million ounces. JP Morgan, 199 million ounces. Understand, these are depository receipts. These companies do not own that metal. They may own some of it, but they don't own all of it. They are providing a depository service. And let me clarify that. CNT, Brinks, Delaware Depository, International Depository, those are depositories. This is not their gold or silver, right? Other companies like JP Morgan may own some of that, but the vast majority of it is actually owned by other people. Then at the bottom, you can see total registered, total eligible, and the combined total. Right? I'm going to close that out, and I'm going to go over here because this is the interesting one. NYMEX and COMEX delivery notices and stocks. You click on there, you can see the silver stocks, the same chart, the same table I just showed you. You can go to gold stocks, it downloads, and you can see the same sort of information for gold. And at the bottom, there's an interesting thing. For gold, they have total pledge. That's 2 million ounces of gold that is held in these depositories, but it's pledged elsewhere, ETFs or other products. So they exclude that. The 44 million ounce total of gold reported to the COMX excludes that 2 million ounces that happens to be stored in these depositories, but A, is not registered with the COMEX clearinghouse, and B, is not eligible to be registered. So that's the important stuff. 44 million ounces. There's 2 million ounces there that could come off of whatever it is pledged to and become available. But right now it's pledged to something else, so it's not really available there. So that's the depository data. Then up here you have delivery notices. And this is great. Let's see if I can get that. These are the month to date, delivery month to date for it. And you have to excuse me that the COMEX has got things. And you can see for the delivery dates, it starts on March 28th. That's the first delivery day, because the delivery process, first off, the delivery process is not delivering physical metal. The delivery process is delivering depository receipts. And it starts the last trading day of the month prior to the delivery month. So for April, on the last trading day of March, those who were short the April contract could say, hey, clearinghouse, I am going to deliver, in this case, let me just make sure it's 87 contracts worth 8,700 ounces of gold. I'm going to deliver them into my April contract, closing out my April short position. Here, you've got the depository receipts already. Go ahead and deliver them to somebody who's long April. The next day, the COMEX clearinghouse actually assigns those 47 contracts to entities that are long the April contract. And this is cumulative. So you can see, okay, the first day, 87 contracts. The next day, first trading day of April, 154 contracts. The next day, 5. You can see that through the 14th, there were 280 contracts delivered, representing 28,000 ounces of gold. I'm sorry, this is all aluminum. Excuse me. I'm really sorry about that. This is the April gold contract. The first day were 34,865 contracts. That's 3.5 million ounces of gold. And then the next day, it was 312,000, 252,000, 600,000, and it diminishes off so that on Friday, it was 187 contracts. Right? And then because it spills over, here's Monday, 511 contracts. The total month to date is 61,000 contracts, which represents 6.1 million ounces of gold. So of that 44 million ounces of registered and eligible metal, 6 million ounces have been delivered through the first half of the month, delivery month, and of that 61,000 contracts, 35,000 were delivered the first day. That is the way that most futures markets work. And then you can go down copper, because this includes copper and aluminum. Then you have gold, silver futures contracts. April is not an actively delivered month, so you've only seen a few, a couple hundred contracts a day being delivered. Somebody did take 730,000, and these are 5,000 ounce contracts. So you multiply it by 5,000, but you can see 2.8. Now, when we get into the May delivery, gold will be very low because May is not an active delivery month for gold. But silver will be very large because you'll have a large position. I'll show you that in a second. And then you can go down to platinum and palladium. One contract's been delivered in the April contract for palladium. March and June are the active months for palladium. And then for April is an active month for platinum. So again, you can see a large amount in the first day, and then another spike here. And if you put those two together, you've got more, roughly half of the month, the first half of the month. But let me get out of this one. So this data is available, and it's available for free. It's available for free right here. Yeah, it's not a big deal, right? Nothing secret here. I want to look at silver futures just to show you. So let's go there. And here again, you can go to settlements. You can see right now, and again, these are 5,000 ounce contracts, so you have to do the math. There's 143 contracts left in April, and there are 65,000 contracts in May. So May is going to be a pretty active month. Now, that a fraction of what it was, because a lot of it has already been rolled into the July contract. And as I said last Friday in our video, a significant amount has been delivered. And I just showed you that there was some deliveries there. So you've got that there. And then I've shown you the silver depository information. So that's all available there, relatively available, relatively free, no costs. You can do this yourself. You don't have to rely on some lying piece of garbage on the internet that says, oh, all of the gold and silver in the COMX has been taken out. COMX is almost empty of gold and silver. And you can go to the COMX and say, oh, excuse me, there are record volumes of gold and silver registered and eligible for delivery in COMEX registered depositories. That man is lying to you, but then you should know that because he's been lying to you his entire career. Here is the clearing, the link for that place I told you where you can get all that information. So that's my tutorial on getting free data on the COMEX. I do want to show you this chart. The left hand is the commercial or the non-commercial institutional investors, commodity funds, larger individual investors. That's their positions in gold futures and options. The data I was showing you earlier was just futures. That's their position. You can see, really, since 1999, investors, generally speaking, had traded gold from the long side. There are a couple spikes down. Most of the volume is on the long side, 30, 35, 40, 45 million ounces of open interest at any given point. And then the green stuff is the shorts that investors or institutional investors or non-commercial participants have. And you can see it's a fraction of that. It did spike, in 2018. It did spike down to more than 20 million ounces, but generally speaking, it's less than 10 million ounces. A lot of people don't like shorting markets. That's important because, again, going back to the history and the raison d'etre for futures contracts were created to provide a mechanism by which merchants, commercial entities, could hedge their exposure to their physical business, right? They did that by creating a mechanism whereby investors could participate in the commodities markets. As those investors said, okay, yeah, I like this is a good idea, there was greater investment demand than there was the need for hedging those futures positions. As a result, you had market makers created who would come in and say, well, I don't necessarily have a physical business, but I will be a broker and I will be a trader and I will sell futures contracts to investors who want long positions but can't find them because there's not enough liquidity. So as a result, you have a lot of futures markets, commercial entities that short the market. Now, some of those are bona fide hedgers. They're hedging their physical positions that they've leased out to commercial entities like fabricators and refiners and wholesalers and retailers. And some of them are brokers. But if an investor wants to buy a contract and go long, somebody has to supply him that contract. And those are the commercials. That's their job. That's what they do for a living. They don't try to make money by speculating. They make money by providing that service to investors. Something that, again, people don't know. And I know there's a guy who put himself out as an expert who clearly didn't know what he was talking about. And he couldn't, like, this goes back to 2021 in the Wall Street silver scandal and all those people who started appearing on the internet talking about silver as if they were experts. And there was at least one guy who kept complaining about the fact that there are these banks and trading companies that are considered commercial traders in the commodities market. That's what commercial market traders are. Refiners, miners, industrial users, electronics companies, jewelers, they generally speaking don't get involved in futures markets. They go through a broker or a trader or a merchant. Let's talk about the state of the world. This is our bubble chart. The green bubbles are good for gold, bad for the world. They're all clustered in the upper right-hand corner. That means that their impact is higher rather than lower. And it means that their likelihood of becoming problematic in the next 6 months is greater rather than less. And the size of the bubbles tell you how big it is. Just graphically, visually, it tells you the state of the world is bad. Just look at the world and you can see that. Another piece of information, there's an outrageous number of people in America who think the Great Depression started under FDR. It started in 1929. The stock market crashed in 1929, but the Depression had already begun to emerge. That's why the stock market crashed. The stock market crash didn't cause the recession to turn into a depression. Other things did, including government policies. But the stock market and the Great crashed in 29. The recession started in 29. And you can see here, under Calvin Coolidge, post World War I, we saw some growth in U.S. GDP, real GDP. There's inflation-adjusted GDP. Some people don't like unadjusted inflation or nominal GDP. Under Hoover, GDP fell, and it fell about 30%. The U.S. economy contracted about 30% over 4 years. Unemployment spiked up to 40%, but it, generally speaking, was about 25%. We worry because we're going above 4% unemployment right now. It was 25% during the Depression, and at the height of the Depression, 1931-32, it was 40%. In reaction to the recession, the Hoover administration and the Congress, it really was the Smoot-Hawley Tariff Act in Congress. And to some extent, the Hoover administration supported it, and to some extent, they went along with the Congress. That was actually passed, created in 1929 as a way of getting us out of the recession. It came into effect, it was passed and went into law in early 1930. It led to a 67% reduction in U.S. imports and exports, and it heightened the depth and duration of the recession. Now, I'll stop right here and point out, if you look at the movable feast, that is what Trump is talking about doing with tariffs. And if you take a snapshot as of Monday, 1/3 of U.S. imports were exempt under the April 2nd regulation that he put forth. 1/3 of imports didn't have any of those tariffs applied to them. In addition to that, on Friday, he said that he had a series of some electronics that would be exempt, representing another 1/3 of U.S. imports by value. So as of the weekend and as of yesterday morning, 2/3 of U.S. imports had no problems with what Trump was talking about for tariffs. Now, over the course of Monday, he shifted back and forth. He's probably shifted back and forth again while we're talking here. So it's hard to say, but about 2/3 of the imports are excluded. Smoot-Hawley was a tariff on everything that came into the United States. Then there were retaliatory tariffs by other major countries, and it exacerbated the global depression that existed. But in the world of bad information, about 1/3 of American adults will tell you that the depression started under FDR, because you got to believe what some demagogue tells you to believe. Now, here's an interesting link. This is Carl Sagan in 1996, warning about the concentration of ownership of information and the depreciation and deprecation of education and focus on science and technology, and the negative consequences for democratic governance and a democratic society, a free and democratic society, of the concentration of ownership of the flow of information. 1996 is definitely worth watching. This is a book called Crack Up Capitalism, which basically goes through the same thing. Quinn Slobodian is a very good, nonpartisan, honest unbiased scholar. He wrote this book a few years ago on that same thing, the fact that you have a group of people in the United States who feel that liberal democracy is a blip in the history of mankind, that mankind, generally speaking, can't afford democracy and can't afford freedom and can't afford capitalism in its unbridled state. So they want to concentrate ownership and they want to limit democratic rule. There are very prominent, wealthy people and very high-level government people who honestly believe that and have been acting in the country's best interest to get rid of democratic rule, democratic governance, free elections, and open society. People should not be free to think and talk about what they want to believe. So this is a good book, but Quinn Slobodian today is releasing another book called Hayek's Bastards. Friedrich August von Hayek was one of two people who were most notable for creating what they called the Austrian School of Economics. Ludwig von Mises was the other one. And the Austrian School of Economics really came to bloom in that period, the 20s, 30s, and 40s, when you saw concentration of ownership, concentration of power on the part of government. You had rise of fascism in Italy in the 1920s. You had rise of Nazism in Germany in the 20s and 30s. You had communism in Russia and in various other countries. You had socialism in various countries. You had revolution in China over this. You had a communist party in the United States. You know, you had socialists and you had all these fascists who were saying, hey, if you're not with us, you're a communist. You know, some dipshit, excuse my language, comment last week was Jeff must be a communist because he's not a fascist. And that's what it was. In 2008, 2009, the Republican Party kept saying that Obama was a communist. And I asked a very prominent Republican who was our client at the time, why are you guys doing that? And he said, in the 1920s, when the Nazi Party, the National Socialist Party, was rising in power, but didn't have control of the German government yet, in their elections, they were saying, you don't have to vote for the National Socialists, you can vote for the Communists. That's the only alternative. Now, in fact, there were all kinds of democratic parties and social democrats and socialists, and there was a small communist party. But they said, no, you're either a fascist or a communist. And people believed them. And they voted for the Nazis. You know, it's there. In that environment, Friedrich Hayek and Ludwig von Mises said, look, we're libertarians. And we would like to see freedom. We'd like to see freedom of expression, freedom of speech, people are able to believe what they want and write what they want and say what they want. They don't necessarily have to have their windows knocked out if they're not pure blood Aryans. And they were basically saying part of the problem is that government has become too powerful and oligarchic power has become too powerful in controlling government, all of which is true. It was true then, it was true in the 60s, and it's true now again. And all you have to do is look at the dispersion of income and look at the dispersion of wealth and control in the Congress and the administration and say, okay, yeah, that's going on. So he came out with this book, Hayek's Bastards. And I have to tell you, he took the name because this was a book from 1993 called Voltaire's Bastards. And it's a really good book. It's a little bit aged for me because I got it in 1993. I guess it came out in 1992. I got it in 1993. And basically, the Mr. Saul, who wrote that book, his thesis was that Voltaire had a lot of good ideas about how reason and rational thinking and critical thinking were important, but that a lot of people have taken his comments and his writings and twisted around and distorted it. And this book, I haven't read it. It's just out today. I haven't even downloaded it onto my Kindle. But this book basically says Hayek had some very good ideas. They're pretty obvious to people like me, I guess, as a free market libertarian. But there are a lot of people who have claimed that they are Austrian economists, and they've twisted the theories around, so they're actually now much more authoritarian. You get to that in a second. Same thing is true with people who say they support Ayn Rand. There are some people who read Atlas Shrugged and say, hey, yeah, that's how I've lived my life, and that's how I want to continue to live my life. But in my experience, most people who think Ayn Rand was smart and was onto something are basically self-centered, selfish people who use her writings to justify their selfishness. Doesn't necessarily mean, doesn't depreciate or diminish the value of her writing or Hayek's writings or von Mises, but you have to understand people will take that and twist it around. A couple data points. Antifa. Did you know there's no such organization as Antifa? There are groups that have now started to use that in their names, but Antifa is a concept, anti-fascist. Anti-fascism is pretty good. It was very important in the 20s and 30s and 40s when we had any number of fascist parties on the left and right vying for control of the U.S. government through the electoral process. World War II blew that away, right? But 420,000 American soldiers died fighting fascism from 1941 to 1945. 420,000 Americans died fighting fascism. So I had no problem being anti-fascist. And I get kind of worried when people say, oh, he's an anti-fascist. I'm as much an anti-fascist as I am an anti-communist. I think both of them are populated by creepy people, right? And that's something to pay attention to because we're in a very difficult place. We are in economically and politically right now. And that's why we're still bullish on gold. Gold prices have been very volatile. They have tested $3,250 the last couple days. Our expectation is that they will go to $3,300 shortly, probably over the course of the second half of April and or into May. The prices may come off a little bit beyond that, and then we have prices rising further going forward. It's interesting that, if you take various groups that have large economic research departments, Goldman Sachs says there's a 50% chance that we will have a recession very soon in the United States, partly because of government policies. They also have upped their gold peak price. I think they're at $3,700 now. We're somewhat lower than that, but not much. JP Morgan says there's a 45% chance of a recession, and they also have increased their gold price projections. Ray Dalio said, yeah, there's going to be a recession imminently. It's not 50% or 45%. The probability of a recession within the next few quarters is almost certain. Yeah. And we pretty much agree with him there. We have shifted. We just updating our long-term 10-year projections for global U.S. and other major countries and regions GDP, and we have increased the depth of the recession that we have been projecting for several years for 2025, 2026, and we have reduced the economic activity that occurs after the recession in the recovery and expansion phase. We're very much concerned about the state of the world, economically, politically, and socially. Silver prices haven't done as well as gold. They were getting up there. They were testing $35. That didn't last. Early April, they came down with fell below $28. They're back up to about $32. Our expectation is that they will rise and rise sharply over the next 6 weeks. Platinum and palladium prices fell sharply in early April, and they are clawing their way back. But they're staying, platinum is staying in that range of 900 to 1,050. And palladium is staying in a very similar range too, although it did spike below it. I've gone on a long time. There's a lot to talk about. I hope this was very helpful. I hope you can take control and do your own research and click on COMX's place to see the data and spend time looking at the data and trying to understand it rather than listening to demagogues and marketeers and snake oil salesmen tell you that the COMX is running out of gold and running out of silver. You can find that information at a click of a button. You can put that stuff in your bookmark and find it every day. Buy our gold yearbook. It came out at the end of March. Our silver yearbook will come out in the end of May. It will have realistic data on how much silver investors have been buying and selling over the course of last year into this year, as well as realistic estimates of the amount of refined silver above ground, mine production, secondary recovery, fabrication demand. Come out with our platinum yearbook at the end. We have a retail investor program which provides lower price point entry for buying CPM Group research and consulting services. You can go to our website. You can read about all of our services. You can pre-order the silver and platinum yearbooks. You can buy the gold yearbook and download it as an ebook. And you can send us a note at info@CPM Group. Take care of yourself. Take care of those around you. We probably will do a video on Friday. It is a market holiday. COMX will be closed. But we may well do a video on Friday. If you don't see us, don't worry. We haven't been grabbed off the streets and taken to an undisclosed location in the Louisiana bayous. We may just take that holiday off. If we don't, you'll see us Friday. If we do, you'll see us next Tuesday. Take care of yourself. Take care of those around you. Try to do something good for the world. We'll see you.